Hey, Rebel Bankers, this is your host, Chris Naugle, and welcome to the show. So I am here with an extra special guest, Dan Handford, and Dan Handford has a unique story to talk about. And we're going to talk about how we got started. We're going to talk about some of the obstacles that he had to overcome to doing what he did. But let me just kind of frame up a little bit about the gentleman that you're going to hear about here in a second. He is the managing partner of PassiveIncomeInvesting.com. He's the founder of Multifamily Investor Nation. He's got over 9,000 multifamily investors and apartment syndicates, which we're going to talk about more. But I think the most impressive part is the amount of time he's done this. See, he's built up over $125 million in multifamily apartments. That's 1,353 units. And he's done it in record time. But before we get started into that, let's talk a little bit about you and your journey to becoming a rebel banker. So a lot of you are at different stages in your investing career, and you're facing different challenges. We all do, but you have to get started somewhere. And one of the specials that I have going right now that all of you should check out is we've got the masterclass going, the Complete Wealth Builder, which is a complete setup for you getting started to how to fund your deals, how to find all the money for all the deals you will ever want to do. So we've got a special going right now. Check it out. It's moneyschoolrei.com/masterclass. And you can grab that special offer right now, which is normally $2,000. You can get it for $297. I had to throw that out there really quick because it's just such an unbelievable value. I want you to all have access to it and check it out. So with that being said, let's jump right into this. Dan, welcome to the show and thank you for being on.
Well, thanks for having me, Chris. Looking forward to talking and sharing my story.
Absolutely. So let's start this real quick, just with your humble beginnings. Like, how did you start? Let's talk a little bit about your first couple deals and some of the things you had to go through. And then what I'm really excited about is to hear about kind of how you got to where you are in the time that you did. But let's start with the beginning.
Sure. So, my background is actually in business. And so I have a couple of online companies that I've run. And I also have some brick and mortar. So I have 5 non-surgical orthopedic medical clinics that I own and run and here in South Carolina. Have about 50 employees in that. And so I actually own the businesses, not the real estate. So that's what caused me to want to get into real estate, though, is because of the money that I was making off of those businesses. And, I was tired of writing 6-figure checks to the government. And so I wanted to try to find a way to be able to offset my taxes. So for me, it was primarily a reason for getting into this multifamily real estate business is to offset my income to be able to reduce my taxable liability. And that's what I was able to do. And we started this about a little over a year ago now. It's about a year and about 2 months.
A year and 2 months. That's incredible. But see, the most incredible part is I know how incredible that is, but my audience here, they don't know quite yet like what that really means. So let's go back to the first couple of deals. Let's talk about those. How did you find them? How did where'd the money come from for these deals? And then let's kind of escalate it and go from there.
Sure. That's a great start. So, the first thing I'll kind of back up with is basically say, when I first got started in the real estate space, I knew I couldn't do it without somebody like guiding me and directing me and having that mentor. I could do it on my own, but I was going to have a lot more of a learning curve to be able to, overcome some of the challenges that somebody might have already done for me. Then I can reduce that learning curve. And so I set out on a journey to be able to try to find somebody that I could, really, understand and connect with. I've had multiple business coaches over the years. And so finding a one in the space that I wanted to was very important for me. And so what I did when I was searching for that person is I went and I said, well, what do I want? What do I see? And what's my vision for what I'm trying to accomplish? And so I found that vision, which is, I wanted to have $1 billion under management of assets under management within 5 years. And so it wasn't a matter of the number of units. It's really about the dollar amount, making sure we had that goal in mind. And so I wanted to find a mentor that was already there or pretty close to there. And so that they can help me get there faster. And so that's what I did. I hired my first mentor and I got him as a coach, and he's helped me along this entire process. And from there, when I first got started into this space, in order to gain that level of experience, I partnered with and did what's called a co-GP or a co-sponsorship with a couple of other groups first. And then when I got my first deal, which we're going to dive in and talk about, right now, is it was a 130 unit apartment complex in Greenville, South Carolina. So I live in Columbia, South Carolina. So this asset was about an hour and a half away from me. And when we first started, finding this deal, what we were trying to do is build relationships with the local brokers, so that those brokers would get to know us and start to actually want to do business with us. And this was one of the very first ones that came online that we really dove deep with in this market. And we really fell in love with it because I have driven by this property. I grew up in the Greenville market. I was there for 27 years. And so it was really kind of more of a passion. And so, but I wanted to also make sure I removed the emotion from it. You close yourself with emotion, or you sell yourself on emotion, but you close yourself with logic. And so one of my mentors had told me that 11 years ago. And so, I wanted to make sure we didn't just buy into the deal just because we were caught up with it emotionally. We wanted to make sure the numbers worked as well. And, just to kind of give you the numbers on this one, the acquisition on this one, we had offered $8.9 million in the best and final round of offers. So usually in these larger complexes, you're going to have multiple rounds of offers. So you'll have this first initial offer, and if you get to the next level, you get to what's called the best and final. And we were in that best and final, and we submitted our best and final at $8.9 million. And on this property, in order to be competitive, we actually did some hard money, not a hard money loan. For those of you who might be listening and are familiar with hard money loans, this was hard money, meaning that it was an earnest money deposit that went hard, which means it was non-refundable the day we signed the PSA. And so we submitted that LOI, and we actually offered $100,000 to go hard day one when we signed the PSA. And
I'm glad you covered that too, because a lot of people, when you say, hard money, they think hard money, but you're talking about when your money actually goes hard, which means the risk is real now.
Yes. And there's obviously some carve outs for phase ones, environmentals, title search and stuff like that. But for the most part, it's hard. Like, you can't close the deal. You can't get the equity, you don't get that money back. But I wouldn't put that kind of money up either if I wasn't confident that I was going to be able to close the deal. And so we made sure that we had all of our equity lined up, which we'll dive into that and talk about that a little bit too, because it was via a syndication model where multiple investors were pooling their funds together. We had 35 investors actually in that project. And so we can dive into that a little bit too. But with this particular asset, we were in the best and final, and we were in the top two. And I thought we were going to get it. And all of a sudden the broker calls us up and says the seller decided to award it to another group. They offered $9.2 million and put $200,000 that went hard day one. And of course, it's like a punch in the gut. We're sitting there going back to our underwriting and our analysis and going, is there any way we can make that work? Can we go back? And we're like, no, it's really that's the number, is 8.9. That was kind of our strike price. And so we just stuck to our guns and just, the deal went away. Well, 4 weeks later, the broker calls us up, and I'm looking at my phone. I'm going, I have a feeling I know why this broker is calling me. And sure enough, it was that very same deal. And the original seller or the original buyer was not able to get the deal done. They didn't even get to contract phase. They were still trying to negotiate the PSA, and they just couldn't agree on terms. And so it'd been 4 weeks now. And so it was getting close to the end of the year too, because they wanted to try to get it closed up before the end of 2018. And so they had called us and they said, are you willing to take it for your other offer at the 8.9? And I was like, yes, absolutely. And so, at that time, of course, I'm thinking to myself, I'm like, I have all the leverage, right? Because now they're coming back to me. They don't have another buyer above me. And maybe I can reduce my offer price, or maybe reduce my hard money, And so one of the first calls I made was to my mentor. And I called him up and I said, listen, one of the reasons why I have a mentor is because I wanted to be able to pick up the phone and call them at any time, because this is a situation where I need some guidance. I needed it ASAP. And so I talked to him about the situation. He's like, don't try to dicker around. He said, just stick with your final offer, 8.9, still do the 100 hard. And he's like, make that broker's life easy, because if you do, it'll pay you back in dividends in the future when they start to send you more deals, maybe even some off-market deals that will work even better than that one. And so that's what we did. Called back the broker, told him we'll take it. We signed all the documents, and we were able to, we did what's called a 30-30-30 close. We had 30 days due diligence, 30 days additional to close, and then we had an additional 30 days as an option to extend. But if we exercised that option, then it would go into the next year, and the seller really didn't want us to do that. And so in the market, though, this seller was kind of known as kind of being like a little bit of a pain to work with. and we executed it like flawlessly. Like we didn't have any issues. We didn't have any problems. All the lending went smoothly, working with the seller and the seller's legal and everything. And even the brokers were talking about how smooth of a transaction we had with this project. And it has really paid off to this day, because we're getting these off market deals. Some of them obviously not so good, and that's why they're off market sometimes. But we are getting some relationships that are really built, and they're creating a very deep relationship with a lot of these multifamily brokers to allow us to get some of these better deals that are coming across our desk. And even when we're on buyer calls and we're investing final on other deals, these brokers are now talking to these sellers and selling us to the sellers because they know we can close.
Yeah, that makes a huge difference. When you show the ability to actually make it smooth and make it easy like that, it spreads like wildfire, which I have a feeling that's kind of going to be one of the things you're going to talk about, is what that transitioned into later.
Well, and just to kind of fast forward to about a month ago, because this is now we're in May of 2019, but about a month or two ago, I had somebody drive down from the Charlotte market. It was actually another syndication group, and they wanted to meet with me and just kind of talk to me and create a relationship and possibly do some deals together in the future. So they drove down to Columbia, South Carolina, and came to my office, and we sat down and started talking a little bit, and they were asking me about that deal. They were saying, you guys got that deal, right? And we were like, yeah. And then they were like, well, how much did you get it for? And we told them 8.9 million. And they're like, you've got to be kidding me. We were in the third position and we were $20,000 less. So what that tells you, though, is that if we would have just, normally, we have all the leverage, went in and said, hey, we're going to reduce our offer price or reduce the hard money, we probably would have lost the deal because it was only a difference of about $20,000.
Yeah, no. So your mentor was absolutely correct, but that's a unique thing. And I'm glad you said that. You were smart enough to know that you could dive into this thing and you could probably figure it out, but you'd figure it out by making mistakes and stumbling along, and it would take you twice as long. And what you did is you knew what your goal was. You knew what you wanted to accomplish, and you went out and found somebody that had already done that, somebody that had already walked that walk and talked that talk. And you hired that person to help mentor you through it to speed the process up. And how true is that? I mean, that is the secret of the wealthy. I mean, that's how the wealthy do things, is they find somebody that's done it to save them time and headaches. And that's exactly what you did. So I commend you for that.
So let's talk about the equity a little bit, because I know that's probably like a question mark in your head right now.
I was going to get there. So let's go right into the money part of it, because that's what everybody wants to know. They're thinking, they see big numbers, and I already know the bigger the numbers really doesn't make any difference on raising it. But yeah, let's talk a little bit about that.
Yeah. So on this particular project, we acquired it for the purchase price of $8.9 million. We also were projecting to do about a $2 million renovation. So it was a pretty heavy lift. We were repositioning it from a C-class property to a B-class property, a higher end B-class, in an area that was already kind of regentrifying into that B-class neighborhood as it was. And so we knew we were going to have a little bit of a heavier lift. So we're roughly about $13,000 a door in renovations on this project. And so what we did with this one, even though it was stabilized, so our group only buys stabilized assets, but a lot of times when you're increasing the renovations and you're doing a pretty heavy lift, sometimes you have to do some strategic or some unique financing on it. And this wasn't really necessarily unique, but we started with a bridge loan. And so we did a bridge loan that allowed us to be able to have the CapEx or the renovation budget to be able to be drawn down over the first 12 months. And so we decided to do that route because it also allowed us to reduce the amount of money that we had to raise for the first deal. And so we raised $2.5 million on that particular asset. And on that asset, it took us about 4 to 5 days to raise that equity. And we were, pleasantly surprised that we were able to raise it that quickly. But one of the ways that we were able to do that was from our network that we had built through the authority platform of the Multifamily Investor Nation. And I'm a big believer in networking and doing a lot of things in person. And so going to these events and encouraging people to join us and go to our website, thepassiveinvesting.com, to kind of find out more information about our group and stuff like that. And they'll go there, fill out the investor questionnaire, and we'll jump on a call and kind of see what their goals are, and if they align with ours, we'll add them to our investor list. And then when we have projects, we can send them out. And so we had partnered with several other groups prior to this first deal of our own, and it allowed us to be able to build that credibility with our investors ahead of time. So they were kind of already primed for when we were sitting down this particular project, which is why I think it funded so quickly.
Yeah, that's incredible. Now, some of these investors, I know you found them through your network, but how did you build the network? Let's take one step further and dive one step deeper into that. So you had this, you had your network, the Multifamily Investor Nation. How did you build that? How did you attract people into that? And who were these people?
Sure. So I'll kind of go all the way back to when I first started that group. So and I'll get a little bit personal. So one of the things that I like to do when my wife and my 4 children are in bed and asleep, I'll usually go out to the hot tub or the jacuzzi and just go out and sit back there and relax. And I get a lot of good ideas there. I also listen to a lot of podcasts and books and various things like that. But I was sitting in the hot tub and just relaxing, and I'm not sure what came across my head, but it just hit me. I was like, I should start a group and just leverage the Meetup platform. And so if some of you are probably familiar with meetup.com.
Absolutely.
And so they actually allow you to have what's called a pro network. And so now I started it, and we have 50 Meetup groups that meet monthly across the country. We have almost 6,000, maybe 7,000 members now in that Meetup group. And it allowed us to be able to really expand fast and quickly. And then I have another podcast that I do with my wife called the Tough Decisions for Entrepreneurs podcast. And we had interviewed somebody on that podcast who was talking about how they put on a live event and they lost a lot of money. And so they decided to just do virtual events. And of course, I'm piquing my interest because I'm like, most of the people, or all the people in the multifamily space and in the real estate space, do live in-person events. And so I decided to leverage that aspect of the virtual events. And so I started a summit, an online virtual conference called the Multifamily Investor Nation Summit. And with that summit, it was really what kind of really catapulted me into the multifamily industry as one of the industry leaders and thought leaders and speakers. And I'm now being invited on different stages to be able to speak about some of the things that we're doing with our group and the success that we're having and the deals that we're closing. And so with that, I invited like 60 speakers that were in this space to be able to speak on that stage. And we had only 2 months to promote it. So we had 2 months to promote it, 2 months to get the speakers, because it was literally like a last minute thing. And I was like, I'm going to do this. So I set the date, and then 2 months went by, and we got 586 attendees to come to that event. And it was a paid event. So we got 586 people there. We had 60 speakers, but it also allowed us to be able to really build our brand in the marketplace for the Multifamily Investor Nation, as well as the PassiveInvesting.com.
That's impressive right there. That many people for your first event just by doing it virtually and it was Meetup. Is that the main source that you used?
So that was a very large source of it. But one of the things that we did is that, we invited the speakers, and we didn't pay any of the speakers, but they also got access to the contact name and email of all the attendees. And so I encouraged them and gave them all the material that they needed to be able to promote the event for me. And so we did spend a lot of money. And so my goal wasn't to make a bunch of money on the event. I mean, I'll be upfront with you. We brought in just about $106,000 from the ticket sales from that event. And all of about maybe like 10 to 15,000 was put right back into marketing the event. So we wanted to have that perpetual marketing going on. And it was to the point where everybody was talking about, they're seeing it everywhere. I even had my mentor call me up, and he didn't call me up, but he had his marketing person call me up and say, he's frustrated because he sees you everywhere, not you. I mean, not him. And so he wanted to know what I was doing. And so I was able to kind of share and be the mentor for my mentor, and kind of teaching them some of the marketing things that we were doing to be able to market the event, to be able to improve them as well. But it was about really trying to not trying to make a bunch of money on the event. It was really about trying to build a massive audience and a massive list, and not just the 586, but I had another like 2,500 emails and names of people that had went to the website that I had to continue to build that relationship with. And then I just continued to provide value. So with the Multifamily Investor Nation, every week I'm doing a webinar about various topics around multifamily, how to get started, about property management, raising capital, due diligence, underwriting, everything. And then we post those on our YouTube channel. And we also do some stuff on Instagram and on LinkedIn as well. So we're kind of, all over the place. And then we also have our own podcast for multifamily, where instead of, just interviewing people that are experts in this field, we're interviewing everyday multifamily investors that are closing deals. Like, they can't even be on the podcast unless they've closed a deal in the last 12 months. And so we dive deep into those deals that they closed, just like I did today. We talk about how they found it. What was what did you do with the structuring of the lending, the financing, working with the lenders on the due diligence and the inspections, and what kind of issues came up, and all of those different things. And then also, how much money did you have to raise? How long did it take you to raise that? How many investors was that? The whole structure of the GP and the LP splits, so they can really understand and really, figure out for themselves about this, the multifamily space. Because as in any industry, there is a language, and I always call it the multifamily language in this space. But the best way to learn the language is by immersion. Even if it's a foreign language like, Chinese or Spanish or something like that, it's all about the immersion experience, the immersive experience. And so one of the best ways to do that is to jump on certain podcasts just like this one, and learn the language, learn the lingo of actually how to do these things. Because the more you can talk the language, the more you can be taken seriously with the people that you work with.
100%. Now, one question I have, and I'm sure this is on a couple people's minds that are going to be watching this. So you've still got your other business, right? It was an orthopedic business, correct?
Yep.
Okay. You still have that. Okay. So you still have that going on. Now, I can't imagine that that's a business that doesn't take a little bit of your time. Plus, you've got 1,353 units, which, hey, I'm not even at 100. So you got 1,300. You're way beyond me. It's just a different business model. But yeah, I know you're probably using management, but talk a little bit about how you manage your time.
Sure. So a couple of different ways. So I'll address the practices first, the medical practices. So one of the things that I did a year and 2 months ago now is I decided at that time, because I was the president and the CEO at that time, and I was going into the office every day, doing everything, from that standpoint, and really, going there, putting out fires, working with various things. And then I went to an event that really kind of opened my mind to be able to step away from that and to really focus on something else full time. And so what I did was I promoted my COO at the time to the CEO. I still maintained 100% of the practice as far as the ownership is concerned, but then I stepped back into the role of just being the president. And so right now, my CEO runs the entire business. And so I usually will look at my financial reports that I get to my desk every Monday morning. I call my Monday morning reports. Usually takes me about 30 to 45 minutes to review those and make any comments to my team about it if I need to. And then once a month for 2 hours, I actually have an in-person corporate directors meeting that I do with my team to be able to make sure that my vision for the practices continues to move forward. But that's the way it's been running for the last 15 months, and it's been doing very well. And so I really delegated a lot of those tasks, so I'm not having to go into those clinics on a regular basis like I was before. And so that was really kind of the first step. And then the second thing is that as I started to build out my team, and a lot of times when we talk about building out a team, we're talking about, finding your lawyer and your the attorneys and, your property management companies and your brokers and things like that. And all of that I was doing as well. But people started to see what I was doing. And I had two people, one that actually went to my church that saw that what I was doing. And his name is Brandon Abbott. And he was the one that really wanted to help me from the construction management because his background is in construction management and property casualty on the adjusting side. And so he has a lot of experience being able to go in and actually estimate what it's going to cost to rehab a particular facility. So he goes in and does all of our acquisitions up front. He tours all the properties. He goes in and does all of the the due diligence, pre-closing. Mm-hmm. So we can actually, he does what we call our pre-LOI inspection. So that's one of the reasons why we get really confident with our hard money day one, is because we already know that we've had an inspection done ahead of time, even though there's going to be a few things that might come up later on. But for the most part, we can pretty much know what's going to come up during a lender inspection. So there's not any surprises for us. And then the second person on our team is a gentleman by the name of Danny Randazzo, and he's a former top financial analyst for one of the large healthcare consulting firms around the world. And so he left that and is working with us full time as one of our partners. And so he is the one that does all of our financial due diligence. He does all of our financial underwriting, our analysis, and he also does all of the property management, asset management side of things from post closing, working with the property management companies to do the asset management piece. Because you're right, Chris, we do have a third-party property management company who is managing each one of these assets, and then we're managing that property management company. And so a lot of the day-to-day stuff is really from a spreadsheet standpoint, but also Danny and Brandon are on phone calls weekly with each one of our property management companies or property managers to make sure that what we want to have done with the property is being done, and that we're being able to hit the targets and the returns that we're looking for, so we can make sure that we have our investors happy, but also each one of us are investors in every single one of our deals, because we want to have the same advantages of our investors, but we also want to align our interests with them as well. So bottom line, I would say, Chris, is that one of the things I learned earlier on in business is that in order to scale and grow, you have to learn how to delegate. And for somebody like myself, it was really hard in the beginning because I didn't really want to do that. I wanted to do everything because one of my biggest flaws is I feel like I can do everything the best and better than anybody else. And sometimes that mindset, not sometimes, but that kind of a mindset will always hold you back. And so one of the things that I decided to do is to change that mindset and really tell myself, if I could hire somebody to do what I'm doing right now, then I can pay them a little bit more, than I might want to, but they can achieve about 85-90% of what I'm able to do. Then I have to just be okay with that. And so that's what I decided to do. And once I started doing that and learning that delegation piece, that's really when I was able to excel and succeed faster than most people.
Yeah, that makes a lot of sense. And, that's a really hard thing to do. I know I've struggled with that in all the businesses I've had. I finally kind of figured that out, and I figured it out because of the same reason you probably did. Mentors kind of pushed me away from it. They said, you just need to, you're doing work that somebody at $20 an hour can do. Why are you worth $20 an hour? And, once you start thinking about that and you're like, no, I'm worth way more than that. And then you put somebody in that place, but it's the hardest thing to pull yourself out of, because sometimes you do get in that mode where you just think, hey, I can do this. Oh, I can do that. And you probably can, but is that what's going to grow your business and scale it? So I think that was a great segue into what I'd like to know next. So you went from the practices, you sort of found somebody to run that. Then you dove into this, you learned from a mentor how to scale this business, build this business. You found smart people through the way. One of the things that I'm always curious about, especially because we're into business, is you're buying so many. I mean, you did this in a year and a half, you said, right? So you built up 1,353 units in a year and a half. And I'm assuming, based on your first model, you're renovating a lot of these units as you're buying them, correct?
That's correct. So the first one is really the major lift that we're doing right now. It's about a $13,000 lift, renovation project. Mm-hmm. Most of ours, though, are anywhere between about $5,000 to $7,000 renovation. So they're not nearly as heavy of a lift, but they are definitely, each one of them have a value add component to it.
And in doing that with a lot of these, because that's a lot of units over a very short period of time, have you had any struggles or any problems finding good quality contractors to do the work?
I mean, it's always a constant battle and a constant struggle to be able to find, those good quality people. But we have been able to find those people, and we have really strong relationships with a lot of the people in the market, because we have, deep roots in the market too, because I grew up there. Brandon actually lived there for about 15 years. And so he has a lot of connections in the market, but also our property management company has relationships that they've built up over the years too. And so it is, I'm not going to say it's a walk in the park, because there are definitely hiccups along the way where, a contractor doesn't show up, or they tell you they're going to do something and they don't perform, or, maybe it's something that's not even their fault. That's like a supply issue or something like that. All those things do play a factor into it. Most of the time we're projecting to turn the units that we're projecting in about a 15 to 18 month time period. And we do that based on the rent roll. We give ourselves a little bit of an extra buffer there just in case there are some hiccups along the way.
And then with where the market's at, I mean, a lot of people, and including myself, are talking, the market's getting to, a high point, especially the stock market. I would say that's definitely in an overheated position, which means real estate could be at an overheated position. So at your level of how fast you're growing, are you doing any preparation for what could happen if the market does start cooling down and taking a dip?
Yeah, absolutely. So that's one of the number one questions that we get from our investors is, what are you doing to prepare for a downturn, and what are some things that you can do to make sure that when there is that downturn, that you have done some things to be able to mitigate the risk there. And there's two main things that we do in our group to be able to mitigate the risk there. So number one, if at all possible, we try to do what's called a permanent financing, where we're doing a 10 or a 12-year permanent, what we call Fannie Mae or Freddie Mac agency debt, where we can get non-recourse financing on these assets. Right now, we're getting usually about 5% IO on a 10-year.
Just, I don't mean to stop you, but when you do that, like with non-recourse, a lot of the people watching the podcast, they may not know what that is. So if you could just maybe just explain non-recourse and kind of what the advantage of that is, and how you've been able to get to that point where you're at the non-recourse level.
Sure. Yeah. So there's a couple of requirements in order to get non-recourse financing and non-recourse debt on a property, but usually the minimum loan balance has to be about $1 million for what they call the Freddie Mac or the Fannie Mae small balance program that they have. But anything that's over 5 units or more, you're able to qualify for this if the loan amount is above $1 million. And so it's usually with Fannie Mae or Freddie Mac, which is what they call agency financing or agency lenders. And with those agency lenders, well, you can also do it with bridge financing as well. So there are some bridge lenders that do the same thing. It just depends on the lender and various aspects like that. But for the most part, we're usually working with Fannie Mae or Freddie Mac, and they are lending out what is called non-recourse debt. Now, there's three qualifications in order to get this non-recourse debt. Number one, your team has to have at least a net worth of the balance of the loan. So if you're doing on this particular one, if we're doing a $8.9 million loan and the loan balance is $7 million, then we have to have an aggregate of our team members that's signing on the loan of $7 million net worth. And then you also have to have the second requirement, which is liquidity, which is typically 10% of the loan balance. So on that particular one, it's $700,000 in liquidity. And then the third thing would also need to be experience managing these types of assets or this large of a budget on a project like this. And so typically, if you can't meet that, you got to partner with somebody that does, so they can help to provide that what they call a balance sheet guarantor in order to get this non-recourse debt from Fannie Mae or Freddie Mac.
Yeah, thank you for explaining that. It's funny. I've got a training tonight about traditional funding sources, and we're going to be talking about the non-recourse loans and some of the things you did. But I just thought when you brought that up, let's just go right into it right now. So, yeah. And so you're planning for what's coming, and you've got a lot of things in play for that. And are you gonna just keep buying into the market as it goes down, and you're using some permanent funding? But what happens when that starts maybe drying up a little, or if interest rates keep pushing higher? I mean, what will that do to your business model and your scaling?
Yeah. So right now, there's I didn't really kind of go into the major, two things, but I'll dive into those real quick here. So the two things that we're doing for mitigating the risk of the possible downturn is getting permanent financing, but not just the permanent financing with Fannie Mae or Freddie Mac, but making sure we're not over leveraging, which means we're going to try to get a lower LTV, which means it's going to be more of us raising more money up front, but it makes for a lower risk deal. And so our investors really like that, because they know that if you look back in 2008, one of the main reasons why the properties went under is because they were over leveraged and they couldn't make their debt payments when they were starting to be a turn, and they were forced to sell the property. And so we try to do right now we're usually around 69, 70, 71% LTV on our projects, but we'll go up to 75%. Unless there's a unique reason, like there was on that one property where we had the bridge financing, which is a lot higher risk, but it also has a lot higher returns for our investors. So it definitely was a little bit of a different, financing structure. But for the most part, right now we're doing permanent agency financing, 5 years IO, 10-year debt with it's usually a 30-year amortization. But right now, I mean, when we closed on that project, we were above 5% interest. Right now, we're in about 2 weeks, we're closing on another property. It's a $16.5 million project, and we actually underwrote that one at 4.8% interest. Wow. And we just got a call from the lender yesterday, and they're wanting us to rate lock at 4.05%.
That's actually pretty.
Right now, the Treasury is going down, so it's actually to our advantage.
It's hugely to your advantage right now, and it's going to be interesting to see how long that continues on that, because we were seeing that tick up, and then all of a sudden it hit that level, and now they're kind of pulling them back a little bit.
Well, and the second thing that you have to make sure that you do, which is what we do on all of our projects, is make sure that you have the lower LTV if you can. But then second, make sure you have enough in operating reserves so that if there is a downturn and you need to ride through a storm, you can. Because the people who were able to hold onto their property and sell about 3 or 4 years after the 2008 crash did phenomenally well when they exited those properties.
Yeah. No, absolutely correct. And I love this model. I mean, it's very, and you know what I love so much, Dan, about this is it's very different than what we're normally talking about. We're often dealing with a lot of people that are doing single to 4 units, maybe some multifamily, but it's not their sole focus. So it's really nice and a breath of fresh air to have you on the podcast here talking a little bit about not only how fast you've scaled this, how you've done it, but also the deep secrets of the funding on that using, the agency loans, the non-recourse loans, and the syndicate. I mean, doing the syndicated funding source, that helps you quite a bit raise a lot of capital. And not a lot of people realize that. But I mean, if you could just tell the audience real quick, and then we'll jump off the money part. I mean, how easy was it for you to raise capital when you had these opportunities for them?
Well, I'll tell you, one of the things I did in the very beginning is I partnered, right? I partnered with some other groups that were putting some of these larger deals together. So it gave me an opportunity to be able to talk to my investors about different projects, because if it was just my very first deal that I'd ever raised for and I'd never had an experience talking to investors, it would have been a lot harder. And I will tell you that very first deal that I actually partnered with somebody else on and I was helping them with their project, one of the things I was doing is raising money for that group. And I set out to raise a certain amount, and I wasn't able to do it right off the bat because it was an uphill battle, because I thought, easily, I think on that one I was carved out for like $500,000, and I thought I would easily be able to hit that because I'm thinking I got like $1 million, $1.5 million that I can raise from my network at the time, and started to talk to people. And the people that I thought that would, they just didn't understand it. They had too many questions. They just weren't ready. It wasn't the right time, which is fine because not everybody is always at the right time to invest. But I ended up not being able to raise the full $500,000 because I didn't have the network in place. And so I had to continue to build that network. And, if you look at some of the SEC laws and rules and regulations around these types of projects, you have certain requirements that you have to have a prior existing relationship with these people. And so a lot of times when people get into this space, they wait to find investors until they have a deal. And that's the wrong time to find investors. You should be finding investors right now. I mean, it's one of the reasons why I like jumping on podcasts like this, is because people get to hear about what we're doing, what we're putting together, the projects, the returns, and then they can reach out to us and say, hey, I'm interested in being one of your partners on one of your future projects and investing alongside you. And so that's what we're doing. We're getting to that point of, getting people to know about us and our group. And if they want to join us, they can.
That's fantastic. Now, and you can, or you don't have to answer this, but I mean, are you doing profit splits with the people you're bringing in on the deals? Is it a flat interest rate? And if it is, like, what are some of the interest rates you're paying for these deals?
Sure. So it's actually not on the debt side. So all of our investors are on the equity side of it. Okay. So of the borrower entity, we usually split them 70-30. So the investors get 70%, and then the sponsorship gets 30%. And we also do an 8% preferred return, but most of our deals are anywhere between about a 15 to 18% IRR.
Wow, that's fantastic. So yeah, that's not hard to raise money when you got that. And plus you've got the track history to show that. Wonderful. Wonderful. So let's jump right in. Dan, tell everybody, if somebody wants to get a hold of you about, becoming an investor, about talking to you about some of your opportunities, how would they reach you?
Sure. So I'll give you 2 ways to reach out to us. So, if you're interested in investing alongside of us on some of our future opportunities that we have available, you can go to passiveinvesting.com, and on there you can find more information about our group. And also there's a button on the page, usually at the top somewhere, that says, do you want to join the Passive Investing Club? And you can join there, and we'll jump on a call. I'll jump on a call with you personally and talk about some of your goals with your investments and what you'd like to see, and kind of tell you a little bit more about some of the specifics on our group. And then the other way, if you're interested in maybe just finding more information about, investing in multifamily, you want to get some more education around it, just go to multifamilyinvestornation.com, and there's some information there about how to join our Facebook group, our YouTube channel, our podcast, and just really kind of opening you up to this world of multifamily so you can kind of get a little more educated behind it as well.
All right. Well, there you have it. So if anyone's interested in doing this kind of investing, I mean, I think you just heard that. I mean, this is somebody that has extensive experience in this, that has done what not many people are able to do from a scaling standpoint, but he's done it because he did his research. He found the proper mentors, connected with the right network, because you know what they always say, your network is always going to equal your net worth, right? Your network equals your net worth. And that's exactly what Dan said. And that's what he did. He didn't just say it, he took action. So with that being said, I'm sure all of you are going to walk away with this from some serious gold nuggets. If you guys are interested in investing, make sure you look Dan up, make sure you source him out, get the proper information and get rolling with it. But the most important thing is taking action. Nothing will ever happen when you're sitting there wondering what it would be like or how it would feel, or boy, I'd love to be in that situation. People get where Dan is because they take action. So with that being said, it's all of your time. It's your time to become a rebel banker, and it's your time to get started in this. I know money is the big thing we talk about, but you keep hearing it over and over, episode after episode, with some rock stars like Dan here and how they've raised money and obtained unbelievable things, like raising, 1,353 units, $125 million in a year and a half. Come on. If it was difficult and if money was that difficult, that wouldn't be possible, but it's not. You just need to find your path and figure out how to tap into all the different money sources. Because the one thing I'll tell you, there is no lack of resources out there at all. And I hope today's podcast teaches you a little bit about the syndication model, about how you can do the multifamily. And I hope that motivates you all to give Dan a call and learn from somebody that is doing it the right way, and not just doing it the right way, doing it without being a risky driver and protecting his investors. There's a lot to be said about that. So all of you rebel bankers, get started on your journey. And I'm going to say it one more time. If any of you want to check out the 4-week masterclass, The Complete Wealth Builder, we have it right now, $297. You just go to moneyschoolrei.com/masterclass, and you can jump on that and get that incredible $297 offer. So with that being said, Dan, thank you so very much for your time on the podcast today. And thank you for sharing some of your expertise.
Thanks for having me on, Chris.
You're very welcome, Dan. We'll talk to you soon.
You too.